it's a pleasure to follow Hal and Jason and the layout of the principles-based nature of the standards and kind of putting it in layman's terms of what the intent of some of the standards are. At PwC, we do a fair amount of work with analysts and investors, and we meet, we have industry meetings, and then we have cross-industry meetings with analysts and investors to get a sense of how they view standards, get their reactions to them. Sometimes that helps inform our positions on issues as well. And some of you in here are familiar with that, and I thank you guys for participating with us. But I also encourage you to make sure that you're staying close to what's happening with standard setting. We often get questions from analysts down the line as to why was this change made or the impact it may have. And we just encourage you to stay close to what's happening with standard setting. And there are opportunities to get involved in standard setting through advisory groups. And you can also get on email lists from the FASB and the firms as well to make sure that you're educated on issues. From the we're just going to spend a couple of minutes to talk about some of what we're hearing from Leases and impairment, the CECL model. And in the interest of time, we'll just hit a few of these items. And as Hal mentioned, when we talk with analysts over the past couple of years, we've often gotten reactions of, well, we don't think the Leases standard will be a big deal. We already take into consideration the footnote disclosures ourselves, but there are nuanced issues and things to be aware of. So I think some of these things are not inconsequential and deserve some attention. I think at a top level, there's been positive reaction from what we're hearing to the FASB's proposed targeted improvements of one, the additional transition method, so you can not have to recast your prior 2 years and do a cumulative adjustment, at least the proposal. And we've gotten positive reactions to that, obviously, because companies would not have to do as much work, or they have a little bit more time in between. You may have leases that expire during that period that you don't have to worry about at implementation. However, business is a continuous process, and then there will be new leases that may have been gone into during that period. So I'm not so sure how much it buys preparers, but there is a positive reaction to it. At some point, you have to implement the standard, and you have to have, and I hate to sound like a broken record, you have to have systems and processes and controls over that information in order to report it. There's also been a positive reaction to the practical expedient from a lessor perspective, so that you don't have to break up the non-lease and lease components under the guidance, and also to the land easement practical expedient, because when you think about land easements where they are long-term arrangements, some of them go on with automatic renewals and things of that nature. So you think about old information and the documentation that is required to bring leases on balance sheet. Obviously, that is a positive reaction from some preparers. And I think under that particular practical expedient, we've asked for an example. I think some preparers want more clarification on that, and I think that might be forthcoming as well. One of the things that we think could be a sleeper issue, so to speak, is identification of embedded leases and bringing those on balance sheet, because as a company, you have to make sure that you look at all of your arrangements, and if the arrangements have an identified asset, obviously, and you have control of that asset and you have a lease, you have to bring that on balance sheet. And when you look at the documentation that's required, and companies may have had these transactions off balance sheet, et cetera, there's more work to make sure that you have the appropriate documentation. So I think the embedded leases may involve more work than some may anticipate, but companies are starting to critically look at their arrangements. They're looking at systems, et cetera. And again, I said from the revenue projects, if there's one thing that companies have learned, and is that you have to start early and you have to dig in. I recently heard someone refer to Excel as the largest ERP system in the world, as we all default to Excel. But again, when you're talking about manual processes, you have risk with that, and then you have the controls over that. There have been some questions about what the appropriate discount rate to use for leases. It should be the rate implicit in the lease or the incremental borrowing rate. There have been some questions about what is the appropriate rate to use. Are we using a rate from a collateralized, the appropriate environment to pull a rate? So those are areas where we're getting questions as well. And then from a lessor standpoint, there are a couple of specific things I wanted to mention from a lessor standpoint. The impact of residual value guarantees. I saw that on Jason and Hal's slide. If you have a sales type lease, this is one of the nuances within the standard, and you have a residual value guarantee. In order to have upfront profit on that, you have to have that residual value guarantee from not from a third party on that to get upfront profit. So that is a nuanced item within the standard specific to lessors. Also, if you have significant variable payments, so for example, in medical industries and things of that nature where a company may be leasing a piece of equipment and there are significant variable payments based on usage, because the variable payments are not tied to an index or a rate, that does not go into the lease, so you can't record those as part of the lease. There is the possibility of having an upfront loss on a lease transaction, and those could be for situations where companies are manufacture or really sell product by lease to get a profit, and they use leasing as a sale. So these are nuances within the standard that companies are dealing with and that analysts should be aware of if they're covering these companies.